Meantime, the major averages all hitting record highs following this morning's cooler than expected inflation report. Our next guest says there could be more gains to come into year end. Let's bring in Bespoke Investment Group co-founder Paul Hickey. Paul, good to catch up with you here. I mean, are we just in don't overthink it mode? We're heading into November. It seems like the bond market's kind of calm about the inflation threat, and we're already up, pretty nicely this year.
Yeah, I mean, those seasonality aspects are all positive for the market going into year end. So that's positive. But the inflation data that we're getting today was weaker than expected, still higher than the Fed's official 2% forecast, but it's moving in the right direction. Price of shelter was at the lowest level in 4 years. And so that's helping to offset some of the goods inflation. So the macro backdrop is very good here. Earnings have been coming in. It's still early, but we've seen some of the highest beat rates in terms of revenues going back to at least 2000. And we've seen the earnings beat rate, one of the highest, like the third highest quarter up to this point, going back at least 20 years as well. So these things are moving in the right direction for the market. We've had a little bit of a pause to refresh in the middle of this month. So I think it does set the stage for some decent returns into year end.
Yeah, really severe 2-week stutter step, right, in the S&P 500 that we've had so far. Paul, we kind of teased ahead to this three-headed monster idea. And in the absence of, lots of real-time government data, what are these three monsters or three-headed monster, and what are they telling us right now about market expectations for the macro?
Well, yeah, just in time for Halloween, we're looking at the 10-year yield, we're looking at the dollar, and we're looking at crude oil. And when you see these three both rising in unison together, it generally causes trouble for the market. When you get them near 52-week highs, it's very troublesome. Right now, all three, they're near 52-week lows, or at least the low end of their range. Even after the gains in oil we've seen in the last 2 days, on a one-year chart, it's near the low end of its range. So in that respect, when they're all down, it's almost like they're bowing and telling the bull market, laying out the red carpet to, keep on going. So in that respect, it's a positive backdrop. And like you said, we're not getting the actual government data or the official data, so these market indicators take on even more importance.
Yeah, and the bull market turned 3, of course, recently. What usually happens to toddler-age bull markets? Once they turn 3, do they make it to 4? Do you expect greater than average temper tantrums? I mean, you study all the historical data here. What can you tell us about what's in store for the next year or so?
Yes. So Leslie, when you get to a bull market, you get the terrible twos in that, once they turn 2, you tend to see some volatility in the markets. And you definitely saw that in the third year of this bull market. Once they turn, the 3-year bull markets usually go on to a 4th year. And just think about it. If you're in a 3-year bull market, there's usually a reason for that. There's usually a big reason why the market has been going up so long for 3 years. Obviously, in this bull market, it's been all about AI. And we just find it funny that this week there's been a number of stories saying if it wasn't for AI, the economy would be flattish. Well, we do have AI, so this is the thing. And AI, I think, last I looked, it's a pretty big deal. So I think you don't want to just take that out of the equation here. But to the point, they usually, once they last this long, they've only 8 out of 9 made it to a 4th year, and returns were decent. So I think in that respect, that's a decent signal. But also, we are always watching the semis again, just looking for market indicators. And what the shift in the semis we've seen in the last 6 months to go from extreme oversold to extreme overbought is very uncommon. And you see that shift for a reason. And when you've seen those shifts in the past, the market has gone on to do very well over the next 6 to 12 months.
Yeah, we've been trying to process what TI even means at this point, given some of the disparity between its action and the others. The other one I had for you, Paul, this week was a 1 week of GEV and a 1 week of Vertiv, and that Wednesday freakout and the fact that they're going to wind up being up on the week. How instructive is that to you, given sort of these AI worries?
So I think some of these stocks that you've seen, you've seen these gaps lower or trade lower, and investors have been coming into and buying them. This is part of a broader trend we've seen all year. This buying the dip, and you haven't seen the market stay down for long. Mike, you were just talking earlier about this 2-week correction we had in the market. It wasn't much because it's really hard to keep the market down here, and so this just shows strong underlying demand in the market. And getting back to the intro to this segment, sometimes just don't overthink it. If you constantly see buying on the dip, it's usually a positive indication for the market.
Yeah, obviously the last attempt to buy the dip is always wrong, but there's many successful
the hundreds
attempts
before
along the
that
way.
are usually right.
That's right, exactly. All right, Paul, appreciate it. Thank you very much.
All right, thanks.
Yeah, I still like that don't overthink it mode. I'm going to stick with that for the weekend.